Hello. Yes, am I audible?
Yes, sir.
Okay. So today we are going to start with our first strategy that would be long call. Okay. So basically the first four strategy would be naked option strategy in which we don't do any kind of hedging. We are just buying either call or either put, or we can go for short call or short. So there are four strategies. So first of all, we are going to start with the first one, that is long call. So in the previous class I have told you about in option when we use the word long, that's mean we are on the bullish side and we wanted to buy a call. Okay, so this strategy is for the aggressive investor who believe that the market is bullish. So if you are bullish about any particular stock or index or any commodity or currency or any other underlying asset, you can make the long call strategy. Okay, so here you can see there is an example. Mr. XYZ is bullish on Nifty on 24 June and the Nifty is closing, it is trading as this price. Okay, so Nifty is trading at this price and he buy a call option with a strike price of 4600. So 4600 spot price is this and he choose the strike price of 4600, that is out of money strike, and that the premium of that particular strike is 36 rupees, 36.35 multiplied by the lot size. Okay, and expiry is 31st July. Okay, so if the market Nifty goes above 43, so he buy the strike, he choose the strike price of 4600 and 36 is the premium. So if you add 4600 plus 36, that would be 4636, which is your break even point. So if the market goes above your break even point, you will start making the profit. And if the market close below 4600, you will lose only this premium. Okay. So here you can see buying a call is the most basic of all the option strategies. Is considered the first option trade for someone already familiar with buying or selling stock. Would now want to trade option. Buying a call is easy strategy to understand. When you buy, it means you are bullish. Buying a call means you are very bullish and you expect the market to rise in the future, in the coming days. Okay. So investor is very bullish on the stock or index. So whenever you are very bullish with the stock or index, you can go for this. What is your risk? Risk is limited to the premium. The maximum loss is the premium you are paying. Okay. So if the market fall or market remain at that particular, you can forego. You can forego your option. The premium you have paid, you can just leave it. Okay, that is your maximum loss. Okay, but we can set a stop loss if the market is not moving your direction. You can set a stop loss and you can exit from the market whenever you want. Okay, the reward is unlimited. So if the market is going in your favor, and you will get the unlimited benefit. Okay, break even point, premium strike price choose plus the premium you are paying. So that would be your break even point. So this is the condition. The market is trading at this level. We choose the strike price of this. This depend upon you. You can choose either at the money. You can go for out of money as well. Okay. It is not preferable to buy in the money because you need to pay more premium. So you either you choose at the money or you can choose the out of money contract, out of money strike price. Okay. Now what will happen? Okay. So in case we have choose the option of 4600 strike price of 4600. Okay, 4600. So if the market is 100 pound down, if the market is 200 pound down, if the market is 300, 500 pound down, here you can see market is down by 500 pound. Here market is 300 pound down. Here market is 100 pound down. So market is 100 pound down, but still your loss is limited to the premium you are paying. Your maximum loss is only 36 point, 36 point, and 36 point. But if the market is going in your favor, so if the market is closing at this point, then you choose the strike price of 4600. Market is now at 4700. So your profit would be 100 point. But because we have already paid 36 rupees premium, so if you minus this amount like 100 minus 36.35, so it would be 63.65. So if the market is 100 point plus, you will get this much profit. If the market is 300 point plus, you will get this much profit. If the market is 500 point plus, you will get this much profit. If the market is so on 700 point plus, you will get this much profit multiply by the lot size, whatever is the size of the lot. Okay, so I can we'll see a live example. Okay, so we are going to like Excel sheet. Okay, now we choose the current example. Okay, so strategy name is long call. Okay, so first of all, I'll give you one example of index with Nifty and another example with the stock. So long call strategy we are using the Nifty as an underlying asset. So underlying asset would be Nifty. Okay, the lot size of Nifty is now 65. Lot size would be 65. Okay, right now Nifty is trading at 24,278, 280 point. So it is 100 point plus today as well. So this would be the spot price. Okay, spot price would be 24,280, 24,280. That is the spot price. Okay, now we are going to option chain and again choose the Nifty, and you can see expiry is on 7th July. So we choose the expiry of 7th July. That will be on Tuesday. So today is Friday, then Saturday, Sunday would be the close, market will close. Then we have only Monday and next would be the Tuesday. So here you can see the 7th of July would be Tuesday and it would be the weekly expiry of Nifty. So either you can choose 7, you can choose 14 July, you can choose 21st July, you can choose 28 July. It's all up to your choice. If you want, you can go for the next month series as well, and you can go for September series or whatever you want. Currently, I am choosing 7 July as an expiry. Okay. Now, market is trading to 24,280. So 280 like 300 would be 24,300 would be the at the money level. Okay, and I'm choosing this one. Okay, 24,400, 100 point plus. So 24,400 is the strike price I'm choosing. Okay. Now premium जो है, what is the premium in points is, let's see, the premium for this would be 42 rupees, 42.65. So in a round format, we choose 42. Okay, this would be the premium I am paying. Okay, premium in amount would be would be 42 multiplied by lot size. So that is the premium I am paying in term of amount. This is the total amount I am paying for this particular strike price. Now, what would be the break even point? Break even point would be this one, the strike price I choose plus the premium I am paying. This is my break even point. Okay. So if the market goes above this level, then I will start making the profit. If the market remain at the same level, I lose a premium. Okay, so I make up a table as well. Okay, profit and loss table. So first of all, I am choosing with the here. Here I can choose 24, 24,442 is my break even point. That is my break even point. Okay. So if the market goes up to 24450, because there is a 50 point difference in the strike price. So market can goes up to this level, it can goes up to this level, it can goes up to this level, it can go up to this level. Okay, that's enough. Okay, if the market going in the negative direction, so if the market is closed 200 point down, then the maximum loss would be 42 point. So it would be fixed 42, okay, up to this level. Okay, and if the market is at this level, okay, so there would be no profit, no loss, it would be 0. If the market is at this level, if the market close at this level, then the intrinsic value of the premium would be 50, but because we have paid 42 rupees as a premium, okay, so the final amount I will get is the only 8 rupees in the positive. That will be 8 rupees. Now you can see the intrinsic value is 100 rupees, 100 point, 150, 200, 250, 300, 350, and 400 point. Okay, so if the market close at this level or this level or this level or this level or this level, you will get the benefit of these points. But because we have already paid the premium of 42 rupees, and that will be the same up to this level. So if you select this minus the premium you have paid would be, sorry. So we have already paid the premium. So this would be your maximum value. So if the market close at 24,500, actually the intrinsic value of your strike price would be 100, but your profit would be 58 point because 42 point we have already paid. Okay, in the same manner, if the market close at this level, then the profit would be 108. Then same way, here would be 158, here would be 208, here would be 258, here would be 308, and it would be 328. Okay, now you can see and multiply by the lot size. You can always multiply with the lot size. Sorry, this one multiply by lot size. So that will be your profit. This one multiply by same way. This one multiply by. Now you can see the more market is going in the upward direction, then your profit is increasing accordingly. Same way. So in this case, you can see your profit is unlimited and your loss is limited to the premium you have paid. Now you can see. Now here you can see your loss is limited to the premium you have paid. Okay. So in case the market is down, maybe in 100 point, 200 point, 300 point, whatever, your maximum loss would be only the premium you have paid. That is minus 42 multiplied by 65. This is your maximum loss. So you can see your loss is fixed. Okay. In this trade, the maximum loss would be 2730 rupees. If the market is 100 point, 150 point, 200 point, 250 point, or 300 point, it can be 500 point, 1000 point negative, doesn't make any difference. Maximum loss would be fixed, the premium you have paid. But if the market goes in your direction, in your favor, then you can see if the market is only 50 point plus, we have already paid the 42 point premium, the profit would be 520. And same way you can see market is 100 point plus, this would be your profit. If the market is 150 point plus, this would be profit. Okay. So actually you will get your whole money, but because you have paid 42 rupees as a premium, that is your profit, and the net profit would be including your premium. Okay. So total profit जो है, total amount you will get would be 6500 in this case, but this is your actual amount you have paid. You will get your money back as well, plus this is your extra profit what you get for your trading. Okay. So this is your basically the long call strategy. Okay. So long call, we have choose Nifty as an underlying asset. Okay. Here would be the lot size. Lot size is 65. The spot price is this. Strike price would be this. Premium paid in point would be this. Break even point amount would be this, and this would be the break even point. Expiry would be weekly. Expiry is weekly. So we have only 1 month time. Okay. And Nifty expiry I have already told you it would be on Tuesday. So this contract is valid for only Tuesday. Okay. So this is clear.
Yes, sir.
Okay. 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 I'm giving you another example of with the stock. Okay. So in the previous class we have seen about like Eternal. Remember, we have seen the long build
Yes,
up.
sir.
Okay.
Yes,
Now
sir.
I'm just showing the chart of Eternal. So we have observed the long build-up process in the Eternal stock along with Maruti as well, and there are few stock as well in which you have seen the long build-up formation. Now, if you see, this would be the 15-minute chart of Eternal, and we have still marked our level. Okay, so we have seen the market was at this level, and this it was my pointer. Okay, after that level the market has gone from this level to this level in the last 2 days. Last time we are discussing at this level, market was at this level. Okay, next day market open again with the bullish momentum, and the bullish momentum continues up to this level, and from 265 to 285 something here. Then here we can see there is a fall in the market because there was a resistance area here around. Okay, the market first resist at this level, then again you can see the profit booking is coming from this level. Still market is right now at this level. Okay, so here you can see the long build-up process. Okay, so now if you buy the Eternal at this level, we can make lots of profit. Okay, now again we are going to Eternal stock. Okay, now you can see it is still 2 point plus. Okay, and here you can see this is the option chain as well. So if I go to Eternal and see the option chain of Eternal and 280 Wally strike price, I can see it was around 5 rupees at that time, and it goes up to 15 point. You can make 3 times money if you buy the Eternal stock on that particular day. Okay, now we choose the same example, and right now we can see with the option and 280 Eternal. Okay, now in the stock we have the monthly expiry only. Okay, now you can see this is lot size of 2425. Okay, if you buy a call option, you just need to pay the premium. The strike price is 280 and okay, so it will not show you here, but it will show only for the selling contract. Okay, so now we go to eternal and again we are choosing the same thing. Okay, now you can see there is a difference of 2 rupees and 50 paisa in the strike price. Okay, now same example if I apply here long call strategy on the same. Okay, now strategy name would be long call. So we are the buyer. When we are choosing long call strategy, it means we are the buyer and we are bullish with the market. Okay, now for the stock option we have the monthly expiry. So expiry would be monthly, so we can hold this trade up to last week of July, last Tuesday of July. Okay, if you want we can hold this contract up to 28th July. Okay, but if you want we can exit today, we can exit tomorrow, we can exit any particular time whenever I want. Okay, maximum time till I hold this contract would be 28th July. Okay, so expiry would be monthly and it would be on 28th July. Okay, now spot price right now, spot price of eternal is 282. We can round it 280. This is my spot price 280. Okay, now strike price we can choose any strike price. Okay, we can choose either 285 or 280. So 282 would be my at the money level. This would be my the at the money level. These are the in the money other one, and these are the 285 would be out of money. So I can choose this 285 as a strike price, and the premium for this particular strike price would be 8.75, 8.70. Okay, so strike price would be 285. Lot size is, we have already seen the lot size is 2425. This is the lot size. Means in the one lot we have 22,425 shares. Okay, the premium is 8 point something. The premium I'm paying for this would be 8.70 paisa. And amount I'm paying for this would be lot size multiplied by the premium I'm paying for this. So it would be 21,097 rupees. Okay. And what would be my break even point? So break even point would be strike price I have choose plus the premium I have paid. Okay. The strike price I have choose is this plus the premium I have paid would be this. This would be my break even point. So if I hold this contract up to expiry, the market should close above this level. Okay. Now we can make a profit or loss table, payoff chart, payoff table. Okay. If the market is up to this level or below this level, okay, so we have choose the strike price of 285, 285. Okay, and if the market is close at 280 or 275 or 270, if the market is close below my level, my maximum loss would be 8.7. This is my maximum loss. Okay, so this will be my maximum loss. Okay, if the market is close, this would be my break even point. Okay, okay. So break even point is when where I will make no profit. Okay. This would be my no profit, no loss. Okay. So in case if market is going between these level, if the market is sideways, okay. So we have choose the strike price of this one 285. I can highlight this. Okay. if the market close at 286 or maybe like 287.5, okay, yeah, 286 you can choose, okay. So the intrinsic value would be 1 rupee. We'll make the profit of 1 rupee, but because we have paid the premium of 8.7, okay, the loss would be, okay, this would be my loss, okay. So if the market is at this level 287 rupees, okay, so intrinsic value would be 2 rupees. I'm making a profit of 2 rupees, but because we have already paid the premium of 8.7 rupees, that's why I will not make profit here, because the premium I have already paid, I'm getting back my premium only. Okay, so this will be, so till the time I am reaching up to this level 293 point, I will not make the profit. The intrinsic value at this point would be on the 285 would be, or it would be like 293, for example, if I say is equal to 293.7 minus my strike price would be 8.7, okay. So the actual value of intrinsic value would be 8.7, okay. But because I have already paid the premium of 8.7, so there would be no profit, no loss. This is my actual profit, but I have already paid this premium, so there would be no profit, no loss. That's why this is a break even point. If the market is closing above this level, for example, if the market close at 295, okay, in that case I'm making a profit of 10 rupees. I have purchased the strike price of 285, market is at 295, so I'm making a profit of 10 rupees. But because of that, I have already paid the premium of 8.7, so my profit would be only 2.3, okay. This one is equal to this one. This is my 1.3 would be my profit. If the market close at 300, now actually I'm getting the profit of 15 point, but this is the premium I have already paid, that will remain the same. Now if the market close at this level, this would be my profit, okay, 6.5, okay. If the market is again more than 305 or 3010 or 315 or 320, whatever, okay, in this case I am making a profit of 20 rupees. Here I am making a profit of 25 rupees and 30 rupees and 35 rupees. That will remain the same, that will be fixed amount, okay. Now I have to choose only this one and okay, same way this one. The, now you can see the profit is increasing now, okay, and here as well, okay. Multiply by the lot size, I have already told you, so my maximum loss is already defined, so is equal to, like, this is my premium or lot size multiply by 8.7, so this is my maximum loss up to this level, sorry, in amount, this is my maximum loss. So still the market is closing at any level, this is my maximum loss, okay. And if the market is at this level, okay, then this would be, and this, okay. Now you see, and again this one multiply by the lot size, okay. So I have paid this much amount and now I am getting back my amount, okay. So if the intrinsic value, we have purchased the strike price of 285, intrinsic value would be 1 rupee, so I'm making a profit of 1 rupee, but because I've already paid the premium of 8.7, Okay, so I'll get back nothing. I will make a loss. Okay, so the premium I have paid, I'll get back only 18,000. I'm only getting 16,000, and till the my break even point, I will not make any profit. Here, my profit would be zero. Now, when the market is close above my break even point, here you can see the market is at above the my break even point. So the intrinsic value of my option would be 10 rupees, but because I have already paid the premium of 8.7, so I will only get the profit of this much. Okay, so this would be my profit, like multiply by the lot size. This is my profit. Okay, now I'm getting the profit. Uh, so I'm getting my amount as well along with the profit. Now at this point, the intrinsic value is 15 rupees, but because I've already paid the premium of this much, so my profit would be, this is my profit. Okay, 6.5. Now again, the market is at this level, so this is my net profit. Okay, and level. Now we are in the profitable area. Again, this one. Now जितना मार्केट अपना ऊपर जाएगी, we will start making the max unlimited profit now. Okay, here you can see along with the, okay, that's how you can calculate your profit. Okay, now this is your one of the example of payoff table. So you can see the maximum loss is already defined. Okay, so if you hold this contract up to expiry, the maximum loss can be this thing. Okay, and if the market close above this level, you can see you are making a unlimited profit. Okay, your profit is increasing after your break even point. After a break even point, if the market is going in above, then you will see the profit is increasing, and that can be unlimited. As much the price of the stock move in the upward direction, your profit will increase accordingly. Okay, now this is how you can calculate your break or profit in this trade. Okay, so this is the example of stock, and it was the example of index. Index expiry is weekly and the stock expiry is monthly. Now, most important thing is that he we don't want to take the loss of this much 21,000, because we cannot bear this much amount. Okay, so it's all up to you. If you want, you can exit whenever you want. So if you think the trade is not going in your direction, you can always place a stop loss. So for example, I have purchased a call at this level and my stop loss is 1 point or 1 point or 2.5. So if the premium value is around 7 or 6, then I can exit. Okay, so it's all up to your choice, because there is lots of liquidity in the market. Okay, so you can exit any point of time. Okay, but if you want to hold this trade up to expiry, so what will happen if the market will not go in your direction? What will happen? The this amount will become zero because of the time value of the option. I have already told you, in the money strike option does not have the intrinsic value, it have the only the time value. So if the market is not going in your direction, the time value will apply, the theta will apply on the uh, premium, and the time value will decay, so the premium will decay accordingly. And on the day of expiry, if the market is close below this level, you lose all the premium. This premium amount will become zero on the day of expiry. Okay, because there would be no intrinsic value of this strike price. But if the market is above your strike price, there would be some intrinsic value, and just because of that intrinsic value, you make a profit. Okay, so this is how you can calculate your payoff table, and everything would be there in your, like in your uh, demat account. Okay, now I can show one of this example. Okay, so there is a website known as Opstra. Okay, here you can make the dummy positions. Okay, so what I can log in with my Gmail account. Okay, now you'll see here you can make all these strategy. So this is a strategy builder. Okay, and here you can make actual portfolio or paper portfolio as well. Okay, so right now the market is about to close or already closed maybe, and here you can see this is strategy builder. So in the strategy builder I am choosing Eternal as my stock. Okay, and I'm applying this same strategy. So I'm choosing a long call strategy, and I'm choosing the strike price of 285. Same strategy, same strike price. Expiry would be 28 July, and quantity would be one lot. I'm trading with one lot, and I'm choosing this to buy. Okay. Now it will show you everything here now. Okay. So here you can see this is the first point. This is probability of profit. The profit probability is 31 point, 31 point only. Okay. Maximum profit is undefined. The profit would be unlimited. Okay. Maximum loss is the amount of premium I have paid. So this would be my maximum loss. Okay. Break even point is that shows you that will be your break even point. 294 would be my break even point. Okay. Now this is the chart, payoff chart. So if the market is at this level, okay, so you can see if the stock strike price of price of the underlying asset is 270 or 254 or 230 or 216, even 170. Okay, our loss is defined. Okay, it would be the total premium I have paid. This is the my maximum loss. But if the market is going above, you can see you will make unlimited profit. Okay, so here you can see the price goes up, you can make lots of amount. Okay, so it can be unlimited. There is no limit to this. Okay, if the market has this level, you will make a profit. If the market at this level, you make a profit of 80,000. Here you can see the profit. It can be in lakh as well. Okay. Now this would be the data for this. Like this would be the delta theta. Theta is 19 rupees. Okay, and the gamma and vega. These are the option key we will discuss in the future classes as well. Okay. Now what I can do is that this is my chart as well. Okay, here you can see the chart, and this is your Greek. So this is the implied volatility, delta, theta, gamma, and vega. These are the option Greeks. Okay, and this is my profit and loss table. So market is closed now. There is no profit and loss, but if the market is open right now, you can see the profit in the real time as well. So this is a paper portfolio strategy. In this in this software or this website, you can make dummy trade or virtual trading. Okay. Now what you have to do, you have to save this strategy and choose a name like long call. I'm choosing long call Eternal, and save this to a paper portfolio, not real portfolio. It is a paper portfolio. So in the free account, I can make up to two strategy. So my paper portfolio is already filled. Maybe I need to filter it. Okay. Now I am choosing saving this strategy to my paper portfolio. Okay. Now, whenever the market will open today, it will show you all the profit and loss in the real time. Okay. Now, strategy is already saved. The market is closed now, so we cannot see any kind of data here. But in the Monday session, we will see if the market is going in the our direction, then we will make a profit. Okay. So this is how we can plan long call strategy. So what you have to do is just follow these same kind of instruction, and you have to make a Excel sheet of any stock in which you have to choose one of the stock as a, or one of the index or stock as an option, and you have to make all these things like what would be the expiry, what is the spot price you are choosing, what would be the strike price, what is the lot size of that particular stock, what is the premium you are paying, and the amount you have paid, what would be your break even point, and what would be the profit loss table. So all these things you have to do and give me you have to send me the as an assignment or as a homework. Okay, so is that clear? Can you make it?
Clear, sir.
Okay, okay. So you have to do the same thing. Okay, now what you have to do is you can see like same way if I go to eternal today itself. Okay, eternal. Now you can see this is eternal, and the same thing like if I choose the same strategies, so it is 30 point plus today. Okay, now you can see previous close was 970. Okay, this was the previous close, and market open at this level, and high is 14. Okay, so if you buy yesterday and today, you have seen there is a 4 rupee difference. Okay, so you can make 1000 rupees out of this. Okay, and as I've told you, like historical data. If you see the 285 or 282, now day before yesterday, the price was only 4 rupee. Okay, now you can see the price 10 rupee 35 paisa and then 9 rupee 35. So if you purchase this option on that particular day, the price would be only 4 rupees, and it goes up to 10 rupees, or today the price was 13. The height of the today is 13 rupees today. Okay, so this is how you can do the long call strategy. Okay, so this is my long call strategy. Okay, so in the next class we will continue with the another strategies, that will be the
Okay.
short call. Okay,
Okay.
so I hope this would be clear. Okay,
Yes, sir.
okay, next class will continue tomorrow at the same time.
Okay,
Okay,
sir.
and two other people will also join that class. Okay, so
Okay.
we'll continue with the next strategy. Okay, in the
Okay.
meantime you can do the practice and same do these kind of analysis in the Excel sheet, and you can make a profit or loss or payoff table accordingly. In the same manner, you can choose long call, or you can use like index as an option, and you can choose stock as an option. Okay, and in the same option website, like I have told you, this is Opstra. So either you can use Sensible as well, or you can use Opstra, or you can make up to two free dummy trade or virtual trade or paper trade. Okay, so right now we are learning on the this one long call strategy, so we can apply the long call strategy on the paper portfolio as well. Okay,
Okay. So tomorrow there is class, sir.
yeah, tomorrow would be also the class at the
Okay.
same time, 3 o'clock.
Okay.
Okay.